Well, let's move right on and bring on board a big voice then, and Keki Mistry. He's the Vice Chairman and CEO at HDFC, now joins in on the show to talk a little bit about the overall macros as well as the growth prospects for the company. Mr. Mistry, good morning and thank you for taking time out. To begin with, given the heightened liquidity concerns that we've seen over the past few months, how are you assessing the entire situation now vis-a-vis what we saw in October? Are you seeing any broad-based improvement?
Well, I think when the ILFS crisis happened in September, there was a tremendous amount of nervousness in the market, and that nervousness sort of got accentuated as some analysts started preparing reports where they started showing the amount of leverage that some of the NBFCs were taking. And markets were very shocked at that time to find that there were NBFCs that had an extremely high leverage and had also a large amount of short-term funding, which they had used to for their funding purposes. So that created panic in the market, and for a period of a couple of months, everything in the market sort of slowed down, credit lines froze. Fortunately, all the commercial paper, the short-term borrowings that the NBFCs had done, largely from mutual funds, all got paid off on time, and there was no default. And as you know, till today, there has been no default. So given all of that, confidence level in the market started improving, I would say from somewhere towards the end of November. And I would say probably even middle of November. And then that improvement continued into December and January. February started seeing some tightening in the market again, February and whatever little we've seen in March. But that is very typical of this time of the year. So you would always find that February, March, liquidity tends to be tighter for a number of reasons. One is that whether you're an individual or you're a company or whatever you are, you pay 40% of your taxes on 15th of March. So suddenly a huge amount of liquidity gets sucked out of the banking system, and that money gets parked with the government. The government starts spending that money as you get into the new financial year. So liquidity starts improving as you get into April and May.
Now, Mr. Mistry, you have NHB. They've proposed a high capital adequacy and capped leverage for housing finance companies. And analysts believe that this may impact the ROEs as well as the flexibility for growth in HFCs. How do you see this proposed NHB norm impacting the sector? Because they're looking to do this in a phased manner over the next few years to increase the CAR to about 15%.
Well, I'm talking at the moment of the overall sector. I'm not talking with reference to HDFC. We'll talk separately about HDFC. I think some tightening in the borrowing norms was something that was expected after the ILFS crisis. I mentioned earlier that there were a lot of analyst reports at that time which talked of very high leverage that the NBFCs and some of the NBFCs and housing finance companies were taking, and that created panic in the market. Restriction on how much money NBFC or a housing finance company could borrow as a proportion of its capital is something that was expected. So what has been announced by NHB, it's at the moment a discussion paper. It's not a final document, but it's not completely unexpected. Now, does it change the situation in the market? To my mind, not very substantially. Only those NBFCs which carry a very high leverage will get impacted by what NHB has said. Actually, what have they said? What they've said is that the capital adequacy requirement is to be increased over a period of 3 years from 12% to 15%. This is number one. Number two, they put a cap on how much money a company can borrow as a proportion, or a housing finance company can borrow as a proportion of its net owned funds. And the third thing they've done is they put a cap on how much money you can borrow in the form of deposits.
Right. Keki, morning. So do you think the entry for new players may actually slow down in the housing finance sector? And do you see consolidation largely coming into works?
We are not seeing any real consolidation happening in the, occasional we hear of cases where companies are available in the are available for sale. Some degree of consolidation may happen. My understanding is that there are close to 100 housing finance companies, and some of them are extremely small in size. So over a period of time, if these very small housing finance companies were to merge with larger entities, yes, you would have some degree of consolidation. But really the big players, the 4 or 5 big housing finance companies constitute a very significant portion of the total housing finance business in the country.
Right. Keki, within the housing finance company space, HDFC has the highest capital adequacy ratio at about 18.9% and the lowest leverage as well in the market. So, as such, HDFC is best placed amongst all the players. But what about the impact over 2 to 3 years or even more longer term because of the proposed NHB norms? Would you be able to maintain these numbers?
No, we do not. We do not believe that with what NHB has proposed will make any difference, and I repeat the word any difference whatsoever, to HDFC's operations over the next 5 to 7 years, or probably even more than that. The reason is that when you look at our capital adequacy, our Tier 1 capital stands at 17.2%, and we have a very low level of Tier 2 capital of only 1.7%, giving us a total capital adequacy of 18.9%. The ability to increase the Tier 2 capital is very high because Tier 2 capital can be 50%, 50, of Tier 1 capital. So therefore, to my mind, the increase in the capital adequacy from 12 to 15%, if it gets implemented, will not necessitate the requirement of capital for HDFC by itself for the next probably 7 to 10 years, or maybe even more. The second criteria, which is the debt equity ratio, or the amount you can borrow as a proportion of your net owned funds, our debt equity ratio is extremely low. Our debt equity ratio stands at 4.7 times, which is probably one of the lowest that you will see in the financial sector in India. And the reason for that is we raised equity last year. So since we raised equity last year, and we don't raise equity very frequently, our equity raising is very, very infrequent.
You know, Mr. Mistry, there are concerns on the real estate sector. HDFC being the largest housing finance player, are you seeing any stress in any specific pockets, or is the stress more in large versus, the mid and small size players? Can you just give us some color here?
Obviously, the larger builders will usually be better capitalized and will have a larger pool of assets available to them. When liquidity is tight in the market, one of the sectors which gets impacted very easily is the developer segment. So therefore, to that extent, liquidity in the market is relatively low compared to what it normally one would like to see. The sector sales have been impacted to some extent because of GST. The reduction of GST from 12 to 5% is an extremely welcome step. But that new rate has been effected from 1st of April. And therefore, one would expect to see that in the month of March, many people will defer the decision to buy a house and will put it off till the 1st of April. So generally speaking, the real estate sector structurally is in sound space, but liquidity issues at this moment are pretty much there.
So for HDFC, we did see the absolute gross NPAs rising by 10% in Q3. Although the broad ratios do remain intact, can you tell us what is the outlook on your asset quality, both on the individual and your loan book?
Well, in the individual book, the gross non-performing loan levels have been very consistent over time. On 31st of December, there were 68 basis points, and historically they've been in the range of 65 to 68 or 65 to 70 basis points for a very, very long period of time, several years in fact. So therefore, there has not been much change. Non-individual non-performing loans tend to be more volatile. They tend to move up and down depending upon specific cases or specific moments of time. These are non-individual loans are relatively large value loans. And because these are large value loans, certain loans slipping into a category of non-performing loan can result in a spike in that number in that quarter. In the third quarter of this year, we had one relatively large developer loan in Bangalore, which got classified as a non-performing loan, which resulted in the overall non-performing loans in the non-individual category to go up. But I would like to reiterate that in the overall non-performing loan number, the number is still very low. It's just that in the non-individual category, December saw a spike. Now, the other point I would like to reassure you is two things. One is we carry huge provisioning. We have historically provided much more than what is required to be provided by regulation. We currently carry a provision which is several times more than what we are required to carry as per the NHB regulation. And the other thing I would like to reassure you is that we carry a lot of security.
Right. So will there be a case for cutting home loan rates by HDFC going ahead? And are you seeing borrowing costs coming down for HDFC?
See, I don't want to make too many futuristic comments because there are obviously a lot of plans that we have internally, but these are not in public domain. But what I would like to re-emphasize is that the structural demand for housing in India is extremely strong for a variety of reasons. Housing in India is a lot more affordable compared to what it used to be in the past. Penetration level of mortgages is extremely low. The mortgage to GDP ratio in India stands at 10% compared to 22% in China, 63% in the US, 68% in the UK, and much higher numbers in Denmark and many other countries. Thirdly, the government has given this huge trust on the housing sector. There is the CLSS scheme, the Prime Minister's special focus on the housing sector, fiscal benefits for housing. And the fourth and the most important factor is the demographics in India. 2/3 of India's population is below 35 years of age. And unlike the West in India, people do not buy a house when they're in their 20s. So the average age of a first-time home buyer is typically 37, 38, 39 years. And with 2/3 of the population being below 35 years, what it really means is that 2/3 of the population has not even contemplated buying a house. But over the next 1, 3, 5, 7, 10, 15, 20 years, all these younger people will get to an age where they will necessarily have to buy a house. So there will be a structural increase in the demand for housing loans in India. I don't want to comment into what will happen this month or next month or the month after that, but structural growth in housing demand in India will always remain very strong.
Pleasure chatting with you as always, Mr. Mistry. Thank you so much for taking time out and joining us today on the show.